Hello, welcome to the European Open briefing for Wednesday, November the 8th. I'm Rafi Baijan, currency analyst at XM.com, and we're going to be looking at the latest developments in the currency markets today. It is a rather quiet day, at least in Forex markets this morning. We don't have too many drivers this week, though the dollar is slightly down this morning. It is being weighed by a report in the Washington Post yesterday that said that US senators are considering postponing that much publicized corporate tax cut from 35 to 20%, delaying that by 1 year. So that's weighing on the dollar this morning, and that's helping other currencies rebound following the dollar rebounded yesterday, putting pressure on other currencies, and we're seeing a bit of a reversal of that this morning. The euro had hit a 3.5 months low yesterday. The Aussie and the Kiwi were also down yesterday and have managed to rebound this morning, despite the fact that we're seeing some negative data both affecting the Aussie and the Kiwi. The pound, though, has been pretty much range bound this week. The main focus will be the next round of the Brexit talks, which are due to start tomorrow. And in commodities, oil prices have come off 2-year highs after Chinese trade numbers showed a drop in crude imports in October. But let's begin with the dollar. We can see in orange here the dollar yen, that 8-month peak early in the week of around 114.70. Then it fell back below the 114 level before rebounding back above that level yesterday. Now it's back below it, currently trading around 113.80. The dollar index has been a bit steadier this week, around 94.80. But in purple, we can see the yield on 10-year treasuries that's been steadily drifting lower. Treasury yields had gained initially on the back of expectations that the next Fed chair would be a hawkish one. That didn't materialize. That's partly contributing to that sell-off at the moment, but the main theme at the moment is the fact that the inflation outlook in the longer term remains very subdued. So although we are seeing rising expectations of further rate hikes in the coming months in the US, that's been supporting shorter-term yields. Longer-term yields are in fact not doing so well. They have hit a 3-week low of 2.304%. That's the 10-year yield. Also, of course, that report yesterday in the Washington Post saying that the senators are considering delaying the tax cut in the corporate rate by 1 year to 2019 instead of 2018. But the other thing with that is that the Senate proposal could potentially put it on collision course with the House of Representatives. If the two houses, the Senate and the House of Representatives, fail to reach an agreement, that could potentially delay the tax plan. Republicans are hoping to have that approved by the end of the year. On Thursday, tomorrow, the Senate will publish its full version of that tax plan that's been unveiled already by the Republican Party. The House committee will unveil its revised version of that bill tomorrow as well, and that could potentially go for a vote in the House of Representatives next week. So any signs of disagreement would be seen as negative for the dollar in the short term, at least. Moving on to European currencies, we can see the euro fell to a 3.5 months low, 1.1552 yesterday. That was mainly due to dollar strength. It did manage to rebound, however, it's been helped by reports in Bloomberg that 3 senior ECB policymakers at the October policy meeting on the 26th argued against keeping the asset purchases open-ended. That disagreement suggests that it's unlikely we would see an extension to the QE beyond September 2018, even though it is technically open-ended. It could make it more difficult for ECB, the governing council members to reach an agreement on a possible extension of QE beyond that point. So we're seeing the euro break just above the 1.16 level at the start of European trading. The pound, though, we can see it's been seesawing between a range of 1.31 and 1.32. This week it's currently trading around 1.3140. We've got the next round of Brexit talks starting tomorrow. We're going to see more rounds as the two sides attempt to accelerate the talks before the deadline by December to reach an agreement, or at least on key issues on the divorce settlement before talks can move on to the trade round. There's increasing pressure on the UK government to reach a deal as soon as possible on a possible transition deal because the current uncertainty is increasingly hurting business investment in the UK. We haven't seen too much of a reaction on the heightened political risks at the moment. Theresa May is having more trouble with the government. The Foreign Secretary made some incorrect remarks in Parliament recently and has come under pressure to quit. Also, the UK International Development Minister is under pressure for not reporting or not following procedures on a trip to Israel. So all of that is causing more headaches for Theresa May. Of course, we have that abuse scandal in Westminster as well. So her government is looking very fragile at the moment. But the focus for Sterling, at least for now, appears to be what's happening with Brexit and those talks later this week. Moving on to the Australian and the New Zealand dollars, we can see the Aussie came close to hitting fresh 4-month lows yesterday, dropping below 0.7630. The Kiwi managed to only briefly drop below 0.69, although it did break that level several times again this morning. At the moment it's currently trading at 0.6912. Yesterday we had the RBA policy meeting, which was the comments regarding the inflation outlook and household consumption were seen to be slightly more dovish than anticipated. That's why we saw the Aussie sliding yesterday. It's up today mainly on the back of the fallback in the US dollar because Chinese trade data was negative for the Aussie. Imports of iron ore and other base metals, which are major exports of Australia, they fell in October in China. So normally we would have seen the Aussie slipping, but we are seeing a technical correction from yesterday's losses at the moment. The Kiwi also had some bad news in terms of commodities. Dairy prices fell 3.5% at yesterday's bi-weekly auction. We have the RBNZ policy meeting on Thursday. Well, that's later today, depending on your time zone. There's also uncertainty about proposed reforms for the Reserve Bank of New Zealand's mandate. So all of that uncertainty is weighing on the Kiwi. We're unlikely to see a major policy shift by the RBNZ at its policy meeting. So the Kiwi could struggle to find direction in the immediate term. Before we go, let's have a quick look at oil prices because yesterday they made fresh 2-year highs, but are down this morning. Not too much though, given the solid gains we've been seeing in oil prices recently. Today's losses aren't really very significant. Chinese import data showed that crude imports was down in October, the lowest in a year. So that's put the breather on the recent rally. But of course, overall, the oil market remains very much bullish at the moment. We've got strong expectations that OPEC and non-OPEC will agree to extend the output deal beyond March 2018, possibly until the end of 2018, when they meet at the end of this month. Plus, some increased tension between Saudi Arabia and Iran in the Middle East. That's also supporting prices. No major data expected later today. We can see the Chinese data there. Exports slightly rising by less than expected year on year in October. Imports slightly more than expected, although commodities were weaker. Other imports appear to have been stronger in October. The main data later will be Canadian building permits and housing starts, and that New Zealand policy announcement that's expected at 20 hours GMT. That's it from me. Thank you very much for watching and have a great day.